Hey, what's up? It's welcome back to day. What is it now? Day 14 of trying to become a little bit smarter. So, I think today I'm gonna work on. Today I'm gonna work on my weekly write up for one of my classes, my finance classes, and through that process, I'm gonna have to read a little bit, some stuff about. Let's take a look. I think so. Last week, the write up was about Yale and the Yale Investment Office. So now I think. Oh, and alternative assets as well. So the Norway model. Kids. How does Norway model deal with the following objectives, which is our consider pursue? Provide future income. Okay. Right. So let's read through this 15-page Norway model. Okay. So lecture in finance, the Cambridge Judge Business School, London Business School, and a visiting professor of finance, managing director at AQR Capital Management. All right. 2011, Norway's government global pension fund, the largest investment in the world, and the second largest sovereign wealth fund behind the Abu Dhabi Investment Authority, whose market value is not publicized. Exemplar for investors around the world. This team is now expressed for Norway's management of its wealth, aligned with the fund's formidable reputation in terms of structure, governance, transparency, responsible investing, has been awarded the highest ranking, a score of 97% among 53 sovereign wealth funds in 37 countries. Wow. Including investment performance and degree of professionalism. Okay, so Norway model is virtually the opposite of Swenson's model. It's constrained to low tracking error and has a rigorous asset allocation that allows little deviation from the policy portfolio. So we should note here that Norway depends on beta, so what are called beta returns. From tracking specific indices / baskets of securities. It also has a big, so it also allows little deviation from the policy portfolio allocation. This contrasts with the Swenson model, which aims for investment managers to bridge their deficit and systematic risk exposure by. Okay. This is different from the Yale model because Swenson is looking to capture inefficiencies in the market via external investment managers. Public securities. Okay, so there's also a big difference here with public securities. So it seems like Norway depends on a lot of public securities as opposed to Swenson, which is allocated a lot more to private equity and more commodities, absolute return type strategies. Yeah. Norway is one of that was. Sixth largest oil exporter. Hydropower meets virtually all of the nation's electricity needs. Wow. Oil production. Norway was recently ranked world's 6th largest oil exporter and 11th largest oil producer. Excuse me. Mass substantial wealth. The government pension fund Global was formally set up in 1990 as a petroleum fund to manage Norway's resource wealth in a long-term and sustainable manner. The original idea behind establishing the fund was twofold. First, the fund was to serve as a long-term savings vehicle would seek to secure the income from a non-renewable resource by diversifying into a broad portfolio of international securities. There is an ethical obligation to share the wealth from natural resources developed over millions of years, which future generations use these savings to cover government expenditures that we associate with an aging population. Okay. Who knows the Dutch disease? Experience of other countries have shown that the receipt of a sudden increase in natural resource wealth can rapidly inflate domestic prices and the exchange rate, decrease international competitiveness, and result in deindustrialization. Further potential problem is that enormous resource wealth can de-incentivize citizens from working and developing their human capital. Estimated to form 82% of Norway's wealth per capita, far exceeds petroleum wealth. Okay. Percent allocation in equities, therefore after further innovation strategy. 60%. The fund security holdings will continue to grow as some of oil-based revenues and investment returns exceed spending. The original 2011 the Government Pension Fund Global. $180 billion. Jeez. That one has some assumptions. Yeah. To the extent that the fund remains willing to bear risk, consumer with its continuing long horizon and returns on capital exceed net withdrawals, the fund will continue to grow. It's off to the cycle. Having a lot. To maximize international purchasing power can mix up levels of risk responsible for long-term management of the fund. decides on the levels of acceptable risk, constructs a benchmark for share allocation to asset classes, which also criteria of management ownership in the overall investment universe. By presenting significant changes to investment strategy, the development for effectively support sufficient to help public understanding of performance through subsequent financial downturns. Okay, so return on investment is to fund state budget transferred to finance non-oil deficit. So, wow, 4% real returns. Nice. Okay. Financial quarterly reports and an annual listing of all investments, including their size and information on voting. Indeed, the Norges Bank Investment Management has, since the first annual report to 1998, provided much more information on strategy, investment. Gives the GPEFG a natural relative advantage for harvesting liquidity premia. Second, this long horizon makes the fund more tolerant of return volatility, short-term capital losses. Most other investors should lean toward earning higher risk premia, notably through an equity focus. Third, most institutions with a small capital base may be able to leverage up small risk premia that offers superior reward per unit volatility into harvest. So it has a really long-term investment strategy. Low need for marketability. Okay. Gives natural relative advantage for harvesting liquidity premia. Second, this long horizon makes the fund more tolerant of return volatility and short-term capital losses than most other investors, so it should lean toward earning higher risk premia, notably through an equity focus. Third, whereas institutions with a smaller capital base may be able to leverage up small risk premia that offers superior reward unit volatility, harvest liquidity premia in niche markets. The fund size makes it impractical to exploit either of the sources of value added. Fourth, capacity issues also favor benchmarks that are at least loosely linked to market capitalization. Fifth, as a large, long-horizon investor with relatively stable risk preferences over time, the fund may most effectively earn liquidity and other premia by serving as an opportunistic liquidity provider through contrarian actions in liquid markets, and through buying unpopular asset classes. 6. As long as oil remains a significant underground resource, the CPFG arguably has less need for inflation hedging than most investors, and a deflation scenario is a more damaging tail risk than an inflation scenario. Because nominal government bonds are the best deflation hedges, it may be reasonable to hold some government bonds despite their low expected returns. So why are nominal government bonds the best deflation hedges? So deflation is the idea that your currency, or I guess your buying power for a specific currency, increases. So it's the opposite of inflation, where buying power decreases for the same amount of currency. And I guess, okay, so nominal government bonds, they'll pay out a coupon at a fixed payment, and so with those fixed coupon payments or fixed interest rates, that'll stay the same, and that'll give you a payment that is more valuable in a deflationary environment. I think that's what they mean by having a deflation hedge. Okay. So that's interesting. Enki. I'm gonna send week 2B Norway model. Add Y. So what is a good hedge against deflation? Y. So yeah, I'm gonna create this flashcard real quick. So what is a good hedge against deflation? Let's see. Holding government bonds should be a good hedge against deflation because this allows, because these securities have a fixed payment so a coupon that becomes more valuable when prices fall. So buying power increases. Coupon becomes more valuable when prices fall. Okay, nice. As noted by the Strategy Council of the Ministry, CPFG long-run investment strategy should reflect its distinctive characteristics. Okay. Explain its investment strategy. And so I say they're pinned by several core beliefs. A belief that markets are largely efficient, a commitment to diversification, a focus on earning risk premia. So I guess risk premia is just the same thing for risk premium. You're taking on higher risks to earn a higher return. A clear articulated benchmark, careful selection and monitoring of asset managers, especially for less liquid assets, and a commitment to responsible investing. The last is integral to the fund's value system. In addition, certain fundamental requirements must be met: effective control of operational risk, exploitation of the fund's size and long horizon, adherence to good governance principles. This continues a heritage of disclosure and communication by the fund, in which NBIM describes its investment philosophy and core principles in annual reports, articles, and presentations. These include extensive explanations of how the fundamental law of active management was the foundations of the fund's investment style. Okay. The investment strategy of the fund has two broad elements. The long-term strategy is articulated by the asset mix in a strategic benchmark portfolio as decided by the Ministry of Finance and Parliament. Benchmark allocation to each asset class defines the fund's risk tolerance. Second, active management by NBIM is permitted to pursuit of return in excess of the benchmark. Okay, the compensation of the strategic benchmark dominates total portfolio risk because active management is constrained by small permitted. It's constrained by small permanent tracking error relative to the fund's benchmark. Okay. So it doesn't seem like for tracking the strategic benchmark. It is a risk management control tool reflecting the level of risk inherent in the asset allocation, regarded as acceptable by the Ministry of Finance in conjunction with Parliament. Europe, excluding Norway, 35% Americas, Middle East, Africa, and 50% Asia, Oceania. Strategic Fund Index has a 60% weighting in the Barclays Capital Global Aggregate Index and Barclays Capital Global Inflation Linked Index Europe. 5%. yeah, I forgot what purchasing power parity meant. Wherever possible, portfolio rebalancing is pursued by allocating the monthly revenue inflows to the asset class region with the largest negative deviation from the benchmark, and operational costs are controlled by adjusting existing positions when feasible. 8,400 companies was among the largest shareholder, a considerable number of companies. Played on the left side. Okay. That's a natural. 0.6%. Global blown market capitalization is shown on the right hand side. Norway has set up a system called Government Pension Fund Global that acts like a sovereign wealth fund. Earning provides future income to its citizens. This company invests in a mix of public equities, bonds, and real estates that providing future income to invest in a mix of public equity, bonds, and real estates. Funds mix of public equities, bonds, and real estate helps develop the Norway economy by making investments within its country and enhances strategic shifts through investing in other countries by investing in there. Investing in their nation. Okay. to market account. It was an interest in London's Regent Street. Okay. Internal and external investment managers. Trading in equity markets. So the Americas. Global 1.2%. Peer comparison, Norway's active management exceptionally low. More sustainable long-term financial results. Interesting. The fund's approach to ethical investment has been widely referenced. These managers should follow a screening that takes sides. What the manager is concerned with. "52 companies were excluded from the fund's universe." Wow. Wait, what are those companies? From Boats, Airbus. Huh. Register of cannabis. Interesting. Production of nuclear weapons, BAE systems. Coal or coal-based energies. Duke Energy Corp. Yeah. Philip Morris. Yeah. Okay, interesting. I think what I'm gonna do now is probably come back to this. I'm super, super hungry. Ugh. Need to eat some food before I come back to it. So I'm gonna do that right now, and then I'll come back hopefully in like 30 minutes. Peace.